Okay, we started the recording. So, if you, and maybe it's easier to understand through through examples. So the examples that I gave you, and so this requires a little bit of knowledge of the market situation and how it operates, how the world international gold market operates, so that essentially when you're looking at a rupee versus gold price as well, it's really not to be treated as as an outright position, but really to be treated as a spread position if you're managing risk. But in India's situation, because our capital markets are quite restricted, effectively you can't do that. Theoretically, it would be that way, but because the capital markets are restricted, effectively it would be treated as a. I mean, you can't do risk management by splitting it into two. But that we discussed that we can do it in the case of when you have gold versus yen. All right. So I think we talked about this as well. That long intra-market spread, also called an inter-month spread. This and so this we have also seen this part. Okay. So we've covered this part. Now we're just moving on. We'll just try to cover this note in sequence because this note is prepared in that way, so that we eventually get to the. You will notice that I've taken that thing out of your. I've taken that thing out. So I've taken that thing out of your folder at the moment, but this is what you will see in your case project magma resources folder, and we are discussing this note, which is not the one on swaps, but actually the one on. I've put the separate note on. Okay, so this I've not yet put into your folder. But there will be a note on there will be a case. Before that, we are doing the technical note for the case, okay, which is this. We are going through certain important concepts. Now, this you guys already know, remember, so it's easy to understand in terms of risk that arbitrageurs don't take any risk. It is a recap, and hedgers always, the first transaction will increase the total risk. And here, I think somewhere I've given the total risk is defined as risk on underlying position plus risk on hedge position. We will understand this a little better as we go on with these discussions. And let's look at so arbitrageurs. You have understood these are guys who are trying to do CRA. Okay, so they're trying to make so there will be no risk. Okay, so you can actually highlight this. Risk is common everywhere. Okay. So you have this risk and looking to increase their risk, right? Yeah, and the speculators are increasing their risk, and we have two types of speculators: directional speculators and market makers. Okay. So in this particular project that we are going to do, you will be functioning as a hedger. So we will see how to understand, how to manage. There are certain principles of managing risk, and we will explain and understand some of the concepts that we need to deal with in managing risk, which is what we are going through. So underlying position and spread position was one of the important concepts, and basis risk will come to later. We had a look at it. Okay, so let's go in sequence. Let's look at risk definitions and taxonomy. Okay. So there are various So the thing to note about, so there are various definitions of risk. Okay, you can either define it in this way. So the normal common sense definition is, I think, the one and the two, there should be two actually. One and the two together, that the possibility of risk and and how much risk do you face, that I could lose so much money, etc. And then when you combine, you can combine, or risk is either possibility of losses, okay, qualitatively talking about possibility of losses, or an estimate of how much losses you might, what quantum of losses you might have, or essentially this is a combination, or actually we can write this as combining one and 2, right? 3 comes a combination of 1 and 2, and expectation of losses, that is, maybe we can make this a little bit better looking here. Expectation of losses, okay? So expectation here is used not in the sense that I have an expectation that it will rain tomorrow, not in that sense, and not in the sense of anticipation, but in the probabilistic, in the probability expectation sense, mathematical expectation. Okay, so we write this as E, capital EX. Okay, so here we would write it as capital E. Then in stats it is normally written like this. Okay, so if your expectation of X is E, capital E, and with brackets X. So here I'm writing an expectation E less. So this is the way. So this is the way of combining it. Okay, of explaining your risk. Okay, so the one thing to note about this is that that the main thing is that generally in academic finance we look at standard deviation based measures of risk, which is what you saw in option trading as well, historical volatility, etc. These are based on standard deviation. And so standard deviation, as you know, is kind of a symmetrical measure. It looks at it assigns equal weight to variations on either side of the mean, right? So therefore, it's a symmetrical measure. But so many people who believe that risk should be, including me, okay? So if you look at academic finance, they don't worry about all these. They don't think about all these complications. They just define risk as standard deviation, which is, as you know, a symmetrical measure of risk. But many people, including me in the markets, we look at risk as an asymmetrical idea. We are not concerned with upside variation, where we're making money. We are only concerned with downside variation and loss of capital, loss of starting risk capital. So therefore, we only look at it as an asymmetric measure. So therefore, we don't like to use this kind of, you might have heard of the Sharpe ratio. You can check this out actually on your own. Okay, you know the formula. We can just, you don't have to memorize the formula, but you should just understand. This is just it's a profit divided by the excess return divided by the standard deviation of the excess return. So it's just just a ratio. So this you can check it out, but it's a symmetrical measure, and sometimes and so therefore people who don't like that, they don't use the Sharpe ratio. They use return to maximum drawdown, which is what I've been using for your projects, the first 2 projects, which I think is a better measure actually. This is maximum drawdown. Okay, which is you take the period return and you divide it by the maximum drawdown, and the drawdown is a much better risk. At least I feel that the drawdown is a much better measure of risk than a Sharpe ratio, which is a standard deviation based ratio. So therefore, it is a symmetrical approach to risk. So drawdown, as you know, is a asymmetrical approach, looks only at the downside. So, or there is another one called the Sortino ratio, which is it's a bit mathematical. It requires integration and all that. So, what do you call that? A definite integral. Okay, so it requires that. So it's looks a little complicated, but the main idea is that this is similar to return to maximum drawdown, because in this Sortino ratio also, so you should be familiar with these 2 names. Just have a look at eyeball the formulas. And so in the discussion of risk and calculating risk adjusted returns, in this kind of a context, okay, when we are having this kind of a discussion, risk and risk adjusted returns, the Sharpe ratios, these terms should be understood by all of you. Okay, so I'm not going to go through this. Just you can go and have a look at the formulae and just get a sense of it. I'll just tell you that this is a symmetrical use of standard deviation, and this looks only at downside standard deviation. And return to maximum drawdown, you already know what that is. Okay, we have already used it. So just be aware of these terms. Okay. So here we want to just look at the definition, and then we have taxonomy of risk, which we have seen before in one of the earlier notes, but I did not discuss it in specifically. Okay, so let me see. Yeah, if we have this, right? So we'll come to this when we go to market risk. Let me just click it open here and we'll come back to it. Okay, so these are the types of risk. Now there are many different people can do different types of taxonomy for risk, but I prefer this one. Okay, so you have all these different types of risks. So market risk, credit risk, financing risk, and operational risk, and legal regulatory. Okay, these are all the different types of risks that you can have, you can look at. So because when you're studying risk, because this whole project is about corporate treasury risk management, therefore we need to have, when we're talking about something like risk management, one of the important things we must do is do a taxonomy. When you're going to manage risk for a corporation, it has many different types of risk. So how should you look at, wherever you're getting into an area, you're getting into some kind of study, then you must do a taxonomy of the field. That's very important. That should be your first starting point. Okay, if you're studying, diseases, then you have to start doing a taxonomy of different diseases. Okay, and so therefore, so in this case, you look at this. So your market risk is basically nothing but this idea that we have, where any kind of stuff, that any kind of prices moving up and down, that's your market risk. Okay, so this is just the stuff that you guys have seen, like some of you have been complaining that we have lost money in the projects. So that's market risk. Okay, you bought something, you bought an option, and then the price of the option went down, or you bought a stock and the price of the stock went down, or you sold something and the price of that thing went up. So that's your market risk. Okay, anything that relates to the price, market price movement, okay, of assets. Okay, now another thing you should be aware of, that I have taken this term called liquidity risk. Okay, in many books you might see an additional thing called liquidity risk. Okay, but I'm not using that term, liquidity risk, because I'm including it in market risk. We have very different categories. Financing risk, just putting everything in bold here. So if somebody tells you, okay, if somebody asks you, okay, what are the different types of risks, you can, this is a reasonably comprehensive taxonomy. Other people may have slightly different taxonomies, but this is a reasonable comprehensive taxonomy of risks. Okay, market risk. And somebody tells you, okay, why didn't you mention liquidity risk? Then you should say that, well, liquidity risk I include as a subcategory within market risk, because what is the impact of liquidity risk? It just means that if I have, if this is related to get to slippage. Remember the idea of slippage? Okay, so this is basically, let me remind that you don't strictly need it here, but just to make you guys remember that word once again, the technical term which you should be aware of. So connected to slippage. Okay, liquidity risk is not slippage, but connected to slippage. Slippage, as you know, is, we have a definition for slippage in the notes, which you should not memorize, but it's very simple. It's a very simple concept to understand. Slippage is wherever you had put your stop versus where you actually get out. Okay, so here, if I, so many ads. Okay. Okay, so here if I go short and I put a stop at 112.50, but the market, there is lack of liquidity in the market, and so they're not, and my position is very big, so I have a buy stop order, stop loss buy stop at 112.50, but the liquidity is so poor that maybe the stop is getting executed before, just between the transition to New York and Wellington early in the morning. So therefore, very poor liquidity, and then the slippage is very high, so that the amount of maybe $4 or $5 billion against the yen has to be bought to execute my stop. And so the stop gets done at, instead of 112.50, it gets done at around 113 or 113.60 or 113.50 or something like that. So full 1 yen difference in the net price of executing my stop. So that's the slippage from the time from the point where I left the order, 112.50, and the point where it actually gets done. Okay, so that's your slippage, and this is connected to poor liquidity. So that is why in many books you'll see that there is a separate category called liquidity risk. I've not done it. I've put it inside market risk because it ends up getting manufactured as market risk, because you end up losing more money. You end up losing more money than you thought you would, because the market is not as liquid as as you would have liked it to be. Okay, that's one. Market risk, very easy to understand. Credit risk is multiple types of risk. One, you have a straight out credit risk for banks, where State Bank of India lends money to Kingfisher Airlines, and then when it comes due, the loan comes due, Kingfisher Airlines can't pay because they're not making enough, they're not generating enough cash flow from their operations, so they're not able to pay the loan, so they default on the loan. Okay, so that's your a classical example of credit risk, which is where the borrower is defaulting, and this is what we call credit risk, because the term credit, because this is based on a initial lending borrowing transaction. Okay, so SBI extended credit to Kingfisher Airlines, and Kingfisher Airlines failed to pay them back, and so that's why this is called credit risk. Okay, now there is another type of credit risk which you have to understand, which is related to. So there are actually two types of credit risk. Maybe we should put them as two slightly different types of credit risk. In both cases, actually, money owed is not paid, but I think we should still understand there are two different types of risk. And so money owed is not paid, so therefore, I really don't want it to go to the next line. Yeah. Okay, borrower defaults. All right. In both cases, actually, money owed is not paid. That's why it's called credit risk. Okay, you owe me money, and you're not going to pay it. So that's why, and therefore I lose money. So that's why it's called credit risk. But so one type is a very simple example where you lend money in the bank or any other kind of institution, and you don't get the money back. The second is trade counterparty walks away from deal. So let's look at this deal, where let's say I have a deal. Let's say I have a transaction with Sachin, where I am selling dollar yen to Sachin at 103. Okay, so here what is happening? Let's look at our example here. Let's understand what is counterparty credit risk. We know this kind of example we have seen before in the discussion of exchange traded markets, but let's look at it here. 8th Jan. No, today. Sorry, I'm a little behind on time. Okay, so let's say I have sold. Okay. Sold USD and got JPY, okay, and at a rate of, let's say, here, you can say 108, okay. At 108, I've sold USD and bought yen. Okay, so this is let's say a 3-month forward contract. Okay, so it's a 3-month forward. Okay, 3-month forward contract. All right, and I am the seller, and Sachin is. So I've sold US dollars and bought yen. That means Sachin has bought US dollars and sold yen. Okay, he has agreed. So this is a 3-month forward deal. So the settlement. So once again, we recap some of the fundamental concepts. The transaction date is today. The maturity date, the settlement date is 3 months forward. The contractual obligations are already crystallized on the transaction date itself. Okay, so here RRS has sold US dollars. Okay, at 108. Now what happens? Let's say at the 3-month forward date, what happens? Let's say the price is, okay, 3-month forward date, the price is, and let's say the amount that we have sold is 100. $100. Okay. So on the 3-month forward date, what is happening? The new price is say 97. Okay. So now price is 97. Now what happens? Now the time for maturity has come. Now how is Sachin going to? How am I going to sell the dollars? By let's assume that I don't have the dollars. Okay, I will receive the yen and buy the dollars. Okay, so therefore what I look at is now what is happening here at 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 the rate of 97. Okay, when the rate is 97, now how many dollars? $100 I have to. I'm going to. I'm agreeing to deliver $100. Okay, so at a market rate of 97. At when the dollar yen exchange rate is 97, so $100 will be, let's put it this way, $100 at the rate of 97 yen per dollar is going to be it's going to cost me 9,700 yen. And here the exchange rate is 100 into no, we don't want this. So this amount of yen that is in the contract, okay, and so what am I going to do? Since I've agreed to sell dollars and buy yen, okay, I've agreed to sell dollars and buy yen at a rate of 108, okay, and Sachin has agreed to do the opposite. Now, if I sell at the rate of 97, at the current market rate of 97, if I use yen to buy dollars, buy $100, okay, and sell it, I will need only 9,700 yen, okay, and therefore with that I can satisfy my contractual obligations. And what I will receive on the contract, remember I've agreed to buy yen, and Sachin will give me 10,800 yen for my $100 according to the contract. So in this case, what is my surplus? I'm supposed to receive 10,800 from Sachin if I give him $100, and so this is and I have to pay him 9,700. But actually, in the sense that I have to pay this to the market, I will take 9,700 yen, and with that I'll be able to buy $100, and I will deliver that $100 to Sachin. So this is actually my surplus. Okay. So in this you can see that I am making money, and this is the amount of money I'm making. Okay. Now what might happen is that now here you notice what is Sachin's obligation here. He is basically, let's put it this way, he has bought USD and sold yen. He has agreed to buy USD and sell yen. Now he has bought USD and sold yen. Okay, what is his obligation? Okay, now he has agreed to do it at a rate of exchange 108. Okay, he has agreed to buy USD and sell yen at a rate of 108. So what is Sachin doing here? He's looking at the market and seeing that the market is over here, and he has agreed to buy a dollar yen at 108. Okay, so he's going to say, "Oh, I'm not a fool. Why should I honor this contract to buy a dollar at such a high price when the actual market price of dollars is 97 now?" So he's going to tell me that, okay, I'm not going to honor this deal. You can do whatever you want. Okay, this is like that Akash Jamal and Mullah Daud case that you did, where there was a contract for the sale of shares, and so one of the seller delivered the shares, but the buyer never paid the money. Okay, so it's the same kind of situation here. All right. So I'm the seller. I'm delivering. I'm ready to deliver the dollars, but he's not willing to do the other side of the transaction, okay, because he looks at the market and he sees that this is the market. The dollar is much weaker. So why should I buy like at dollars at 108 when I can buy it at 97? Okay, so he goes and buys it in the market at 97, and he just tears up my contract. Okay, like he's not going to do the contract. So this is what you call counterparty risk. Okay, This is also called counterparty. Have I used the word credit risk? Yeah. So this is actually called. This is a term that we used, if you remember, in the. I'm not going to write it here again. So maybe we can write it here. We have used this term, if you remember. We have used this term in the exchange traded markets discussion. Okay, so this is there in the entire discussion of ET markets versus OTC. Okay, this is called counterparty credit risk. Okay, where he was my counterparty, Sachin was my counterparty, and as we came to the settlement date of the transaction, when we looked at the value of my contract, the value of my contract is actually, this is what we say is the value of my contract on this date, because at the market rates, I was going to receive 10,800 yen under the contract, and at the market rates, I would have had to pay. I would have had to pay out only 9,700 out of that yen to buy the $100 that I'm supposed to deliver under the contract. So therefore, if you look at the yen surplus, remember this is dollar yen trading. So all the P&L will be in the terms asset. It will be in the yen. So in the yen, I was showing a profit of. So my mark-to-market profit. So this counterparty credit risk is related to the mark-to-market profit as well. Okay. So all these concepts are connected. Counterparty credit risk, M2M. I'm going to write it here also, so that you remember all these words. Because whenever you do any of these concepts, all the related concepts should all be springing up in your head, and that way you will remember everything much better. Okay. So the related concepts here are basically counterparty credit risk and mark-to-market. And here's my mark-to-market profit. On the day of the settlement, I look at my P&L, and actually it is showing a mark-to-market profit of 1,100. And this is how it's going to be calculated. Okay, you can see how the calculation was done. So, but it's a counterparty credit risk because Sachin owes me this money effectively, because he's going to deliver the yen at the contract rate. And so he essentially, because of his obligation, I will stand to make this much money, but he walks away from the contract. Okay, so that is why counterparty credit risk. That's why I've called it counterparty walks away. Trade counterparty walks away from the deal. Okay, this can happen in the financial markets. This can also happen in any other kind of transaction, right? Or it can happen in a sort of a business deal as well, right? So then you have a breach of contract. So then I will sue Sachin here for breach of contract, okay, and I will be entitled to damages. So I will ask for damages for breach of contract. So then that's what's going to happen. So this is called credit risk, okay, very important type of risk. So the two main important types of risks are these two, okay, market risk and credit risk, very important. And when you look at this point, I think we should go a little bit to the market risk and look at this. So when you look at, I've given the risk here, that market risk, this is a point that I should have mentioned. Maybe I could mention it at the top, but anyway, I've not done it because I wanted to give the categories together in one flow. Okay, so here, when you look at market risk, if you're like, there are many positions, for instance, where you can, there are many positions where you work as a market risk analyst, all right? So you can look at these positions as market risk analyst. You will be looking at how will you do that job. You will have to further classify market risk along the lines that we have shown you here, that when you look at a market trading operation, typically the right way to look at it is like this, that look at all the asset classes and look at all the instruments, okay? So if you're on a big trading floor, a big bank trading floor, like some of the pictures that I've shown you, you will see that there will be a spot currency trading desk. Then next to that, there might be a money market trading desk, which is basically money markets means debt actually. The asset class is debt because they'll be dealing with interest rates. So there'll be a spot money market trading desk next to that. So this is the way you look at risk analysis for big markets operations, market risk jobs. When you have jobs in market risk, this is the right way to look at it, is to look at each asset class. And so the trading room will be organized according to desks. So there'll be a spot currency trading desk, and then this can be further split into. So this framework is very useful to look at market risk, because if you're doing this kind of analysis, you will split it up. You'll split up the entire trading operation into categories. First, I'm going to look at currency trading operations, commodity trading operations, equity trading operations, etc., etc. And for each of these, I'm going to go again instrument by instruments. Okay, let's look at the spot currency trading desk. Let's look at the FX option trading desk, and so on and so forth. Okay, so this is how it goes. And so, and again, within this, you would again, so this is how you do a market risk analysis. You would again within spot, if you're looked at just for one example, forget about all the other work that you have to do. Even in just one case, what you would do, just to give you an idea as to how the framework proceeds, how the approach will proceed, you will start with currencies. You will start looking at all the different instrument types. Is there any cash market trading going on in currencies? Okay, maybe not. Then you move on to the spot trading books. And these are called books, actually. Books in the sense, as you know, books is essentially like, it's almost like the Hindi word khata, which we use. Like the grocer is actually keeping a book for, positions, like for each customer that he's lending money for to. He's got a position where he keeps note of how many things he has sold you, etc. And so it's similar to that. So the book means basically it's a record of all your transactions, and this is called a book, okay, like a textbook. So and so what you would do is, okay, you look at the spot trading books, and then even in the spot trading books, there will be multiple markets. So essentially you will do F2 here. You will subdivide this into, visually I'm not doing it because we don't have the space to do it. But imagine that this is blown up into a big box, and then inside that box you have several small sub boxes. Each of this is for one market. Okay, so inside one of those sub boxes, inside this box, is going to be dollar yen. Then there'll be euro dollar, then euro dollar FX. There'll be Aussie, there'll be Canada, there'll be British pounds, etc., etc. Okay, all kinds of stuff. And so that's how it is to be done. Okay, so this is how you would do it. So therefore, you would look at all the markets, all the different currency markets in which your traders are carrying positions or running books, and they would all be visualized as a sub box within this larger box of spot currencies. And then you have to repeat this logic for all the asset classes and all the instruments. And then you have a comprehensive view of the market risk position of the trading floor, the trading operation that you're looking at. Okay, so if you're looking at the big banks, the big investment banks and commercial banks like JP Morgan, Morgan Stanley, Goldman Sachs, if you're looking at their operations, they will have positions in all these markets: currency, spot, some in futures, some forwards, some swaps, options, commodities, all of these: spot, futures, forwards, options, swaps as well, equities, okay, so, and interest rates. Okay, these are all operations that they have, and all the instruments will be covered, basically all the major: spot, futures, forwards, and swaps and options. Okay, so all these will be there. And then this is a less liquid kind of portfolio, so this will not be located in the trading room. Okay, these real estate, although I've given this as a category, this is not so liquid actually. There are certain futures contracts on real estate, but otherwise it's not so liquid. Okay, so a lot of the real estate positions are actually taken in physical real estate, which is basically spot here, commercial and residential real estate. So like you go and buy a mall, like you buy this PVR Saket mall, okay, and then you invest in it, and then you earn the rental revenue from all the stall owners, etc. So that's most common form of real estate investment. There are some real estate index futures, etc., running, but these are not as, if you look at the total amount of investment, it's not as much as this one. Okay, so therefore real estate is slightly different from the rest because it is not so actively traded in a financial market form. Most of the volume is happening through the physical real estate market. Whereas the other asset classes are different in that most of the trading is happening through highly liquid instruments like futures, spot, options, etc. So this is how you would analyze a trading operation, and all these big banks, they will have operations across all these areas. It will be huge trading operations. And so there's another term that you should know here, which is, I'm just going to put it here. I don't know where to put it actually. Okay, I'll put it here. Okay, there is a term. You'll see, we should be aware of this. Does anybody know what this means in the context of bank, investment bank trading operations, commercial bank trading operations? Has anybody heard this term? FICC? No? You guys are not?
No, sir.
Yes? Yes, anybody? No?
No, sir.
Okay. So that means you guys are not doing enough. That means you guys are not doing enough monitoring of markets. You're not listening to your Bloomberg TV market coverage. Okay, all this stuff you guys are not doing because that means I would definitely have heard you're not listening to earnings calls of the financial markets players like the big banks and the investment banks. You're not listening to their earnings calls. You would have definitely heard this term. Okay, so this stands for fixed income, which is basically debt. Okay, fixed income is what I have called debt. Okay? If you read the note on asset classes, markets, and instruments, there is one. You should read this note. That is, you guys should read this note. Okay, this is part of your reading. So you should do this reading. You should actually complete all the readings here, not just the ones which are put in bold. This is a sequence. It's like a chapter of a book. Okay, like chapters of a book. You're supposed to do the whole thing, but I had highlighted some for your first project. But read everything. These are important aspects for you. You need to know how to think about these categorizations, etc. Okay, so the fixed income. So this is actually debt. So when you read this, you'll see why. When you read that note on asset classes, markets, and instruments, you'll see this note. When you read this, you'll see why I have not used the word fixed income. In this, I have not used the word fixed income here. See, I have said that it is also called for fixed income, but I have not used the word here because this is not a satisfactory word because some of the income is actually not fixed, it's floating. So therefore, this is not a correct term, but unfortunately, and this is an analytically rigorous name for the category, okay, which is debt. Is the debt or interest rate sensitive assets. Okay, that would be the analytically correct name for the category, but unfortunately in the industry, people the most common term that people use to refer to this asset class is actually fixed income. Okay, so that's how it is, but this is, as I said, in so many other you've seen this in so many other areas that people don't necessarily talk in a manner which represents very analytically rigorous approach to the concepts and the creation of the vocabulary. Okay, so this is just how people are. They just talk loosely, and then this thing gets developed. So fixed income, which is actually debt, and then you have currencies, and what is the last one? Do you think? Commodities. Okay. So if you listen to, you should be listening to, otherwise how will you learn about the financial services industry? You should be listening to these, following Bloomberg TV, watching when these big banks like a JP Morgan or somebody or Citibank, all these guys, Goldman Sachs, when they release their earnings. You should go through the earnings calls. You should listen to the earnings call where the CEO, CFO are going to explain what is happening in our markets. Barclays, I think I gave you an interview of Barclays, of the Barclays CEO in one of the earnings calls, right? So that interview would be here, Market Bits. I hope you guys are watching all this. I've taken so much care to keep it for you guys, and you guys are not watching all this stuff. Okay, some of the stuff that is going on. somewhere basically, right? So I think I highlighted one. Which one? What was that? So that's a Buffett interview. Okay. So I remember there was a Barclays interview as well with the CEO. So if you listen to the interviews, you'll hear about them. You'll hear them talking about FICC, okay, which is, or sometimes they just call it FIC, which talks about their results. So banks very often discuss their results in these categories: debt, which they call fixed income, currencies, and commodities. So the operations are organized in a peculiar way, actually. The equity operation is kept separate, okay, slightly separate from the other three. So they report the equity income some separately, and the fixed income, currencies, and commodities trading business, the incomes are reported together, okay. So that's what you should look at. Now, so these kinds of ideas you will get. So this is an industry term that you should be aware of, FICC, which stands for this. Okay? So it's basically a way of categorizing their operating divisions and reporting their earnings for the big financial firms. Since you guys are finance students, you have to understand, you have to have a very good understanding of how the financial services business operates. So the big financial services firms, the commercial bank trading operations and the investment bank trading operations, the trading operations of the big financial institutions, how do they report their income, and how do they measure their market risk? So this is what we have covered right now, okay. This is the topic we have covered. And so let's look at this. So the next category of risk that we have is financing risk. Okay, so financing risk is where you have, yeah, you can see this. Now, many companies have what we call, there's something called a I'm just setting your yeah, okay. All right. So so what I was saying is we're talking about financing risk. All right, not being able to raise money, it's when you need it, so you don't have. So this is a problem that you find many companies. Sometimes what happens is they have a loan coming due, but so they need to raise money. To usually a lot of money that is raised, a lot of capital that is raised in the capital markets is actually used to pay back maturing debt. Okay, so they sort of pay down maturing debt, so that well, I have $150 million loan principal coming due. I don't really have that much money, so I'm going to issue a new bond for another 150 million, which I will use to repay the proceeds of the old bond. Okay, so I would use it to pay the principal on the old bond. So this is how a lot of financing is done. So a lot of the time, sometimes what happens is the market environment is not good. Like for instance, if you remember, like if you see this, okay, yeah. So the markets are very elevated. Now, if you look at this, now if you were somebody trying to raise money at a time like this, when the sort of the despair about the COVID was and the anxiety and the concern about COVID was very high, and the markets were already at this low point. And now suppose you had a bond issue coming out here. I mean, you needed to issue bonds at this point of time. You might have found that many investors have no interest in buying your bonds because people are all afraid. And so this is what you call financing risk, that you are required to go to the market to borrow money, either to borrow money or even to do an equity issue. Maybe there's an urgent need to do an equity issue, and you have to do it here. And at this point of time, and nobody's interested in buying your stocks. I know people don't want to buy any stocks. You might have seen in the Indian market as well, there are certain times when IPOs are out of favor because equity investors are not they don't feel like taking risk. They're all afraid. They're feeling very anxious. and so they don't want to take any risk. So it's very hard to sell stocks. So this is what you call financing risk. So I've kept it as a separate kind of risk, right? That this is something, therefore, you have to manage. So I've created the categories of risk in such a way that these are going to be the ways you look at it when you're managing. You can manage these risks in a very, very specific way, right? Credit risk is managed in a particular way, market risk in one way, and so financing risk is also managed in a particular way. You might have heard this time that is, so what companies do, especially, or sometimes just called a line of credit. Okay, so standby line of credit, or just a line of credit. This idea that so what happens what a lot of people do, what a lot of companies do is they all have a it's just like a kind of insurance essentially. Okay, this is the kind of insurance. You pay some extra money to the bank, and in return the bank agrees that at any point of time, if you need to borrow, let's say $20 million or $50 million or whatever it is, you can easily ask them to say, okay, now you told me that you would lend me money, 50 million, I need it now, please give it to me tomorrow. That's what it does. Okay, but for that privilege, you have to pay the money. For that privilege, you have to pay money to the bank in terms of a fee. Okay, it's called a commitment fee. Okay, so it's like a commitment fee. And then so these other terms that you need to know: standby line of credit, and you have the other term of a commitment fee. So the bank is making you a commitment, right? The bank is making you a commitment. So there is a commitment fee, right? So that you pay the commitment fee, and then in return the bank will lend you money should you require it. But this is a bit like you may not need it. In that case, you can't ask for the fee. So if I take a 1-year standby line of credit for $50 million, and for that maybe I pay $3 million as a commitment fee, and so the entire year goes by and I don't need to use the line of credit, that does not mean that I can ask for this fee back. Okay, that fee will remain with the bank. So I've already paid that money, so I can't ask for it back. So therefore, this is how you work on assignment. So financing risk, and there's a specific way to manage it. You can have different names for it, but this is one of the common names. But this is the main idea. You have to understand the idea. What companies do is, because they can't afford to be in a situation where they don't have money when they need it. So what they do is they arrange for these kinds of standby line of credit. If you might have remembered, now of course Tesla has become a legendary company. Let's see how the stock is doing. At one point of time, Tesla was in such a difficult situation at one point of time. I remember around this time when it was in a great deal of difficulty. All right, but now look at where it is. And so around this time, they needed to, somewhere around this time, I think they did a preference share offering. Okay, because they needed money. Obviously, they needed money. They had some money coming due, loans coming due. So therefore they did they did a preference share offering, and through the preference share offering, they raised capital to pay off those bonds that were maturing. So when the bond is maturing for a company, then obviously Tesla will have to pay the bond investors back, and mainly they'll have to pay back the principal. So they need money for that, and then they paid it through the preference share offering. So now, of course, Tesla is a dream stock. You can see how dramatic. You might have heard the news that now Musk is the richest man in the world, richer than Bezos. Okay.
Yes.
You might have heard that. So this is how Amazon is doing, and this is how Tesla is doing. Tesla, you might have also heard, Tesla is moving to, I don't know if they've already moved, but maybe it takes a little time, but they have announced that they're leaving California and moving to Texas. Have you guys heard this?
Yes, sir. Yes, sir.
Yeah. Very good. At least you are keeping track of some news. So they're moving to Texas because basically I think is not happy with the business conditions in California. It's lots of power cuts and stuff, and lots of regulation. So generally, businesses don't like over-regulated environments, and Texas has income tax, low income tax, no state income tax. They have a very business-friendly climate, so they're moving there. Lots of big companies, lots of big tech companies have recently announced they're moving to Texas. Oracle, HP, and Tesla also, if you want to look at them as a tech company. It's a very interesting kind of phenomenon that's going on. This is the interstate competition. In fact, if you look at India as well, Bill Gates, I was watching one of the interviews of Bill Gates, and so they were asking him about India, and he said that one of the things that he likes about India is how the states are competing with each other in terms of, okay, who is better, who has a better environment. Like I see some ads from Jharkhand saying that, best environment for business and this and that. So these guys will be competing with the other states. So this interstate competition to attract business is a very healthy thing, because generally we are an over-regulated country, which is a pretty stupid approach actually, because that's why we don't have enough economic growth. And so it's good if these states are competing with each other. But unfortunately, the problem in India is that the massively over-regulated state of the economy is mainly the fault of the central government. So, as we say in Hindi, a bichara state kya karega? Have central government regulation is so bad, over-regulated, that how much can the state do? So anyway, so that is just a little bit of, venting my frustration about India's lack of economic development. But let's go on to, where were we? We were basically talking about financing risk. So I just told you some stories. These are important. I mean, this is how you sort of cement your knowledge, with all the stories that help you to understand the concepts better. Okay. So financial risk, financing risk, okay, don't call it financial risk, it's financing risk, okay. Next is operational risk. Now, I don't know if you've heard this story, but actually this happened when, I was also, we all checked where our hands were when we heard the story. So there was a trader on the German DAX. So, all these trading desks, you all see various computers. So there was actually a trader trading DAX futures on it's a German futures exchange. The DAX is actually the stock index. So there was a stock index, German DAX. Let's show you a picture of the German DAX chart. Let's see. Yeah, DAX index. So this is the German economy. So you should know these things, okay? Big economies, you should know the names of major indices. So this is like the Nifty 50 of Germany, okay, or the Sensex of Germany. This is also 30 stocks, I think, actually. Yeah, DAX 30. You can see DAX 30, okay? So when you see, watch business programs like Financial Times or things. So this is the DAX index. So there are futures contracts on this index, the equity index. And so there are futures contracts. And so this guy, he was trading them, and what he did was he put his hand, he was having coffee or maybe he was talking to somebody. So he put his elbow on the keyboard of the computer, and then he didn't realize that thousands of orders were being entered constantly. So maybe he had set up the keyboard shortcuts or something, and then so there were millions and millions of contracts, sell orders were entered, which he did not want, obviously, to enter. This is what you call operational risk. So these kinds of stupid errors, sometimes people put in extra there. This has also happened. And then they go to the bank and say, please give me back the extra money. So instead of sending $1 million, to, in a remittance transaction, when you're the remittance department, when they have to send $1 million to City, New York, instead of that, they send $1 billion. And so this actually happened recently. Okay. So then you have to go back to the bank and say, please send me back the extra money. So these kinds of things, this is called operational risk, where all these kinds of stupid operational mistakes, you should not be making any of this. Actually, there's no excuse for any of this kind of losses. Sometimes you have losses on account of this. This should not be happening at all. This is going to happen. Okay, market risk. If you're running a trading business, there is no way you can survive without, there's no way that you will not make losses. You will make losses, but you have to control them tightly. This also, you're going to experience trading. Every bank you look at, Nobody has zero credit losses. Okay, it's just a risk of doing business. You're going to have some credit losses, but you got to be able to control it and keep it at a low enough number. Okay, and then you have all this financing as well. Okay, so so operating risk there's no excuse for any operational risk losses. This you can take down to zero, and that should be your goal. Then there's also a matter of fraud. Okay, so all this Nirav Modi and the PNB, this is all in the there is a risk. Actually, there's a complex risk because it is also legal and regulatory risk, because to some extent but mainly it is operational risk, but it's a regulatory risk because then what happens is those who are supposed to be in charge of maintaining this safeguards in the bank, they are deemed to have violated the regulations. So basically, the guy who was checking all the credit facility issuance, the money, the sanctioning disbursement of funds, he did not follow the rules, and therefore he failed in some of the regulatory areas, or the bank senior management failed. But that is a slightly less tenuous connection. So your Nirav Modi type of fraud case, that goes into operational risk. Okay, so one of my former law professor from the U is actually now a CBI prosecutor at this for bank fraud. Basically, he's prosecuting bank fraud cases. So this is an example of operational risk. All right. So this is the another type of risk, and then there you have legal and regulatory risk. Okay, all kinds of stuff. Now, if you might have heard of the Sohara case with Subrata Roy. He was put in jail, but the original problem was that actually they had raised money from more than 50 investors. At that time, the limitation was 50, but they did not issue a prospectus. So that is what we call legal risk, okay, because they violated the law. Under the Companies Act at that time, they were required, if you were raising money for more than 50 investors, they were required to issue a prospectus, but they did not. They tried to be very clever. They used all kinds of clever legal reasoning, but the court didn't buy it. And so that's an example of legal risk, where you end up doing a transaction in such a way that you violate the law. Okay. Then you have, this is very common actually, especially in the case of US sanctions. US sanctions are very powerful actually, because the US economy is such a dominant force in the world. If you are shut out of the US economy, it's a very, very costly affair, which is why if you notice when Trump was issuing the sanctions on Iran early on in his term, it was very effective because a lot of the French companies who are doing a lot of business in Iran, they were told that, okay, if you want to do business in Iran, then you can't do business in the US. So that's a heavy price to pay. So they basically said, okay, we'll just get out of Iran. So but what happens is many countries, many banks, either they have some kind of mix of operational risk and legal regulatory risk. Many banks don't even realize sometimes they make mistakes, but it's mainly legal and regulatory risk. Like Standard Chartered was violating the sanctions on Iran. They ended up doing some transactions with Iran. So the United States fined them billions of dollars. And these fines are very heavy, billions of dollars. So this is a very, very a very costly area where you to make mistakes in. Here also there is no excuse. As I said, market risk, credit risk, these are operational kinds of activities, so operating activities. So you are going to have some losses. You can't have zero over here. There's going to be some losses, but you have to manage it tightly. But these two areas, operational, legal, there is no excuse for any losses on these two areas. If anybody loses money, they should be fired there. I mean, in a good bank, they should be fired. There is no excuse. There should be zero losses on these two fronts. Legal, regulatory, you should be very clear what has to be done. This is called compliance function. So now many of the jobs, okay, so we have actually legal, regulatory, and compliance. Okay, so there's a certain category of jobs. This is not really for MBAs. This is for people who have accounting degrees, or mainly law degrees. Okay, law degree holders, and sometimes accountants and all that. So legal, regulatory, and compliance. This is a category of job, but you should be aware, it's not for you, but you should be aware that there is a type of job. Okay. So you can have trading jobs, you can have research jobs, and you can have jobs in legal, regulatory, and compliance. I would like to fit it into one line if I can. Yeah. So legal, regulatory, and compliance. Okay. So there are certain. So there's actually a. Can we make it? No. Yes. Yeah. Okay. So legal, regulatory, and compliance. So this is a category of. This is like a category of job. Okay. So like an operations job or a research job or a trading job. And here you have one category of job is legal, regulatory, and compliance. So this is basically the type of risk. Okay. So you either violate U.S. sanctions, no trading with Iran, but you end up doing some trades with Iran, they're going to fine you billions of dollars. Okay, so this is basically it. And okay, so let me just use this. Many of you are actually planning to get jobs outside, right? Let me just see here. I mean, in the sense that I think some of you at least are. Let me just look at if we can get something here. Okay, you can actually what I would say in terms of various types of jobs. I'll put it somewhere else. I'll put it in your here. Okay, so look up a site called efinancialcareers.com. We can write it here in today's thing. Okay. Okay, so I'll put it here. Yeah. So look up a site here, the efinancialcareers.com, and there will be jobs in category. Let me see. There's a. Let me see. Here. There is a category called. Yeah, okay. Now this is what I wanted actually for you guys. Put it here. Yeah, there is a category called graduates and internships, okay? Well, graduate internships basically, okay? So this is the thing. So please look at it and have a look at it. It'll give you, even if you don't apply, it'll give you a very good idea to the extent that you want to have a career in the financial services sector. It gives you a good idea about the different types of jobs, and you can look up the other categories as well. And then you can look at the JDs and you can see what are they looking for. What title, like this AI analytics and data scientist. That's interesting that it is appearing in graduates and internships. Here there's a chance of getting in without having any work experience. Okay, so then if you want to read this thing, go look at it and see what they want, what kind of skill set they're looking for. This will help you. Okay, it doesn't matter if it's in New Jersey. It's okay. Don't worry about it. Your goal is to learn about the. Here, your goal is really to understand what the jobs require. Okay, so you can do that. Do this exercise. Check it out. Look at all the different jobs. And so I just wanted to share this idea with you. When I was talking, I was reminded of when I was talking about this category of jobs. Okay, so this is basically the situation here. So we've covered so what we have covered now is the different types of risk. Okay, a taxonomy of risks. We've covered this. All right. Okay, so just coming back to this, that when we are going to be doing our project and when we talk about this topic of risk books and hedging, okay, we'll explain what risk books are. And we talk about this. The main focus for us is on market risk and credit risk. Okay, because these are not risks that we can do active trading in or actively manage, because these are kind of very strange kind of risks. You can't really trade and manage operational risk, and nor can you do that with legal regulation. Different kinds of risk, different types of risk compared to market and credit. These two are much more easily manageable actively, and the risk factors are also being, regularly, the prices are being reset. Price discovery is happening for the risk factors, so we'll see what those are. Okay, so mainly our focus when we look at risk books, I'll explain what that is. Our focus is on market risk and credit risk. Okay, so we already learned about FICC as well. Okay, so another term to understand, we say, is that you take on certain amount of risk when you put on a position. Okay, you take on certain types of risk, a certain amount of risk, and the term here is, so when you put on a position, we say we have taken on some risk, and if your position is actually losing money, then you can say that the risk has materialized. Okay, so we look at two different we're looking at two different kinds of terms. Once we take on the risk, but that means we are now exposed to this risk. It may turn out to be bad for us, but it might not. But when it actually turns out to be bad, we say that the risk has materialized. Okay. All right. Now, what is a risk book? Let's try to understand the next concept of risk book. Okay. So again, it's a little bit. I've tried to write highly specific and highly, precise definitions, because we have to do that. But you don't have to memorize it. The main idea in a risk book is that it's a balance sheet where the assets and liabilities. Yes, what's up?
Sir, how is a risk? I know what is a contingencies, but in this case, like you said, a risk is materialized. Only then we can say that it has given us loss or something. So, sir, how is a contingency different than a risk which is not materialized?
Contingency, depending on how contingency is a word that can be used in many different kinds of contexts. So if you say when we say contingency planning, for instance, when we say contingency planning, we are talking about a situation where we are maybe we are trying to do we are doing a military operation, and we plan to go down certain we were trying to move down a certain valley, but then we do some contingency planning because we may find that the valley is flooded or something like that. In that case, we can't go down that valley. We have to maybe go through on top of the mountain, right? So that's what is called contingency planning, which means that there is a expectation that we are preparing for a scenario where things may not go according to our plan, according to our base case scenario. So that's one way. So in this case, if you're saying, just to understand your question, you're saying how is a contingency different from a risk that has not yet materialized?
Yes, sir.
Yeah, well, see, they are going to be fairly more or less similar. Okay, they're more or less similar, but the word contingency is not used so much in isolation like that. It is used in the sense of what I just said, right? As a word contingency used for contingency planning. Okay. Or we may just say that this contingency has materialized, which would be not very good English, but so it is actually very similar. I understand what you're saying, and your idea is correct that contingency is very similar to a risk which has not yet materialized. Okay, a risk which exists theoretically. Okay, that means if I'm doing skydiving, there is a contingency that, well, the language is not very good if we use it like this. That one of the types of contingency planning I will do is, what if my parachute doesn't open? Okay, So that's a kind of contingency planning. So the contingency would be that the parachute doesn't open. So it's a visualization of the kind of a adverse scenario. Okay. So this is how you should think about it. You can just think of it as using the terms that I've given you, that you assume some risk or you take on some risk initially. Okay. When you put on the position, that means when I'm doing skydiving, I assume the risk that my parachute may not open. Okay. But if I jump and then it actually does not open, then we say, okay, that risk has materialized. Okay, but obviously most of the time the parachute opens. Yeah, is that clear?
Yes, sir.
So I think it's better just use my vocabulary. That will make it clearer. Okay, but your thinking is correct. You're thinking along the right lines. Okay. All right. So the risk book. Let's look at a risk book. What is a risk book? Okay, so it's a balance sheet. A useful way to think about a risk book is a balance sheet. Okay, where assets or liabilities. I should not say just assets and or actually can change in value as a result of changes in relevant market prices for assets or liabilities. So balance sheet, assets and or liabilities, keyword, can change in value. Okay, change in value as a result of changes in relevant market prices. Okay, so you have different types of assets on your book. You have done this already. Now you've already seen this when you did the last two projects that you did in your courses. The last two projects, you were basically trading what is called. I'll explain the difference later on. We are coming to that, active versus passive. But you were essentially running an active risk book in your option trading and your spot trading, because when you bought a bunch of stock, okay, like Aman had done one day. Aman had bought I don't know, millions of options. It was almost like operational risk. I think he might just put his elbow on the keyboard or something, and lots of stock, lots of options he had bought. Okay, I hope Aman you don't mind my talking about that event, but anyway.
No, no, sir, no, sir.
Okay, so then what happens is then he has ended up, what is Aman's balance sheet now looking like? Where before he did that, what happened? He had a balance sheet of $1 million cash, and the liability side is owner's equity is $1 million, and the asset side is $1 million, and the type of asset is all current assets, cash. Okay, now still remaining in current assets, but now he's looking at cash and marketable securities. So there is a subcategory. So big category is cash and marketable securities. Earlier it was only in cash. Now he has spent $500,000 buying all kinds of options. So therefore, after he has bought all those options, what is his balance sheet now looking like? Still, let's assume that there is no change in the value of the options, but initially at least, now he's got $1 million balance sheet size, $1 million owner's equity, and he has got a balance sheet on the other side. He has got, look at this. So owner's equity he has got on the liability side. So he's got 1 million, and on the asset side, okay, initially he started with 1 million, and that full 1 million was only cash. Okay, now he has got, and this is basically owner's equity. All right, and so this 1 million was cash. Now after doing the transactions, he still got, initially there is no change in the value. Okay. So then he does a $500,000 worth of transaction options. So now he's got 0.5 cash and 0.5 different types of option positions. Okay, all kinds of calls and puts on various companies. All right, he's got that. Okay, so $1 million owner's equity, and this is the second balance sheet. First snapshot of the balance sheet is this. Then first snapshot is here. Second snapshot is here. Now, what is the third snapshot? The third snapshot is, we'll take the same thing here. But the third snapshot is now his options start to change in value. Okay, so we put a different color to show that it is a different phase. Yeah. So now what has happened is that some of his options, the cash remains the same. Cash doesn't change in value, but some of his options have lost value. So now these are standing at 0.35. Okay, right? So obviously now this is what it is. Now this will obviously have to adjust because this will have to be down to this plus this obviously. So your owner's equity is now down. Okay, so you have experienced a loss, mark to market PNL loss of 0.15. Okay, because the options which you bought for $500,000, they are now worth only $350 million. That's it. So this is what you call a risk book. This is a simple way to understand a risk book. Now, in the place of options, you could have replaced it in this example with spot equities, which you did in your first project. Same concept. Initially, when you do a trade, maybe you'll do a bunch of initial trades. You keep $500,000 in cash and you put in $500,000 invested in the different shares of different companies. And then after about maybe 2 hours, you look at the balance sheet again, and you see that these marketable securities that you had, options and spot equities, they have changed in value. You were initially worth $500,000. Now they're worth only $350,000. So this is what is meant by a risk book. Okay, it's a book. It's a book because it's like a balance sheet. Okay, so it's a useful way of thinking about it. It's a book because it's a record of transactions in actively traded assets, and we represent it. The best way to do it is to do it through a balance sheet representation. And it's a book, and it's a risk book because the assets and liabilities are such that now this is not a risk book. Okay, understand this. If you look at this in isolation, this is not a risk book because you don't know that. Obviously, you don't know that Aman is in the business of managing money. You don't know all that. So if you look in isolation objectively only at this risk book, this is not a risk book because cash does not change in value. There is no risk on this book. Okay, because cash does not change in value. So as long as you have this kind of balance sheet, and that's all that the computer will see, let's say the AI computer sees only this, then the computer will not call this a risk book because cash cannot change in value. As soon as you go to this situation, this becomes a risk book because we know that this could go up or this could go down. Okay, and so here also it is still a risk book because this can go further down or it could go up. So both ways the values, of course, if it goes up, then you really don't experience risk because you're not losing money. You're actually, from this mark to market point, you're actually making money because it will go up. So that's the situation. So this is what we mean by a risk book. Okay, a simple way to think about it. Once you get an example, it's easier to understand. That's why you see why I have this very complicated definition. So it's not so easy to understand when you read the definition. But once you understand the concept, then you understand the components of the definition. Remember when we looked at the legal language, we talked about the ingredients of a section. When you look at a piece of legislation, like say Section 17 of the Registration Act or something like that, you can see, we look at the ingredients, we call it the ingredients of the section, which is the key words in the section, which you have to look at, okay, which give you a sense of what is actually the essence of the law, right? So here the ingredients: balance sheet, assets, liabilities changing in value because market prices for assets and liabilities are changing, or as a result of credit events, okay? So a credit event is a material event relating to the creditworthiness of a borrower. Okay, so for instance, another way of having this result of credit events is basically, so that's why you have two types of, that's why I said we normally look at two types of risk: market risk and credit risk. So here what Aman is facing, this is market risk. Okay, this would be market risk because he bought a bunch of stock options. So if you use your market risk analysis framework, you would find Aman on the equity options trading desk, and you go and look at his book as a risk manager. You go and look at his book and you find he has these positions. He had $500,000 worth of long options, and then you go and see him after a couple of hours, and you see his losses are grown, and he is now position value is worth this much. So this is market risk, an example of market risk. Okay. Now, what would be credit risk is if you have the same thing, you can take. Okay, we can take this down here. I have that feeling that it was good. All right. Okay, so your class is over. The students can leave. So this is market risk. Let me just write this here. Yeah, and if you have anybody has a conceptual question, I'll take that first, and then we will talk about any administrative questions. Does anybody have any conceptual questions in the meantime? No? So we'll see this as an example of market risk, and then we will leave it tomorrow at the next class, that is tomorrow itself. We will talk about credit risk. So in this manner, we will understand various types of right, so these are the risks. Okay, right. Okay, so I guess guys, no questions. Then I will just end the class.
Sir,
Yeah. Yes. Let's go with whoever. I think who Srishti was first.
sir,
Yeah. Okay, let Srishti go first. Yeah.
Yeah, sir, I'm not able to access the Google Sheets. It is saying that I don't have the access.
No, yeah, because I took it out, no? So I take it out before the class in case I'm asking you guys any CP questions, so that nobody should be able to. Now, once you're there, let me just stop the. Shaurya, your question is conceptual or administrative?
it is kind of administrative only.
Okay, so I'll